Wonderful. Good morning, everybody. For those of you guys that don't know me, my name is Sarah Rodriguez. I'm CEO and counsel of Titan Title. I'm so excited for this amazing mastermind. If you see me looking to the right, I'm letting everybody in. I'm manning that. As Titan Title, we do business in Virginia, Maryland, DC, and Florida. And one of the things is that we love empowering our clients through education. So every single month, we do a virtual mastermind of information for our agents that is going to be of value to you guys. But more than that, we're trying to create a community. People like working with people that they like. So I want to encourage everybody here, since you have people here who are from Virginia, Maryland, DC, and Florida, and all over the country, make sure that you're spending 2 minutes to go into the chat and put your name, contact information, and what areas you do business in. Because again, we want to make sure that we are referring business to those like-minded individuals. Today, I am really, really excited to bring a speaker who is one of the most amazing speakers that I have ever seen. I've been in this industry for many, many years. 3 years ago, you heard me saying that I had 25 years in the business. 4 years from now, I will still only be doing 25 years in the business. And it is very hard to find someone who is in the industry and has that perfect balance of wanting to do stuff for the industry and be helpful, but also encouraging others to build wealth, because that's what we're here, is not just to build our wealth, but to build the wealth of our clients. I'm really excited to have Mr. Charlie Einsmann from Clear Sky Education give this amazing presentation today. I'm going to turn it over to him, but a few ground rules. Please keep yourself muted. If you have questions, put them in the chat. I will be making sure that I am looking at that. And at the end of the presentation, Charlie is going to go ahead and allow for questions and answers. So Charlie, take it away.
Well, welcome everybody. Sarah, thank you very much for having me. I'm actually really excited about giving this presentation. We have a couple of presentations that people absolutely love. Number one is the how to find distressed assets presentation, and this one is right up there with having to, how to find distressed assets. Funding your investment deal with little or no personal money. And so what we're going to do is I'm going to take you through 4 funding sources and how to, buy investment properties. And then what I'm going to do is at the end, I'm going to tie the 4 funding sources on how you can use all 4 or any of the 4 to buy your, first investment property, your third investment property, or your 100th investment property. And so the way the presentation is structured is that I'm going to cover hard money lending. I'm going to cover debt service coverage ratio lending. What is that? I'm going to cover subject tos, and then I'm going to cover owner held financing. And then what I'm going to show you guys how to do is combine the different financing strategies so that you can buy investment properties with little or no money out of your pocket. And with that said, let's move on. That's who I am. If I'm new to some of you guys, I've been out in this space for a very long time. 22 years of real estate investing. Just like Sarah said, I haven't hit 25 years yet, but once I hit 25, it's going to stay there forever. I own a bunch of things. I actually own a real estate brokerage, Virginia, DC, or Maryland, even though I'm not a broker, my partner is. I own a bunch of other business lines, and I'll sort of cover that here with Clear Sky Group. We have a 6-pronged business model. The first one is fix and flip. We have fixed and flipped over 400 houses, and we still fix and flip every now and then. The second business line is we have a residential rental portfolio of a lot of assets. Right now, I think we're up around 55 residential houses that we own. We manage everything. The third business line is commercial properties. We own a few commercial properties as well. Next business line is hard money lender. Clear Sky Financial is my hard money company. We have about 40 million on the street. DC, Maryland, Virginia, and I will stress Florida, because I think a lot of you guys are in those areas. So we do direct lend in DC, Maryland, Virginia, and Florida. We've added North Carolina, Louisiana to the mix as well. Don't do too many deals in Louisiana, but that is part of our mix. Then the last but not least, my next business line is tax lien certificate investing. We buy tranches of tax lien certificates in Washington, D.C., Montgomery County, and PG County, Maryland. That's another business line. And the last business line that we're doing is we just launched it about a year and a couple months ago is our Clear Sky Education. We offer coaching and mentoring. We wrote a book called The Roadmap to Wealth in Real Estate Investing. If you don't get a copy, buy it. It's basically our story on how we grew with little or no assets, and we've taken those assets and invested into what's called passive income, and that's basically a cover of that. Basically, is what our roadmap looks like, and I won't cover that very long. We do have a podcast out if you guys are interested. We used to have a podcast called Basement Tales. Now we've got the Real Estate Riches Roadmap, so that's out there for you guys. There's a lot of free information out there for that. Okay, let's get into the heart and soul of this. What are we going to be talking about? Well, first of all, what are your investment property needs? We're going to cover fix and flip financing, how to finance your fix and flips. We're going to cover how to finance your buy and holds. We're going to cover transactional funding for wholesalers. And it's funny because Sarah doesn't realize it, but she just received a deal from one of my students who is going to actually utilize transactional funding because he's getting a pretty good size wholesale fee. And on the other end of it, the owners, it's a divorce situation, husband and wife. And so we sort of don't want the divorced couple to kind of see what the wholesale assignment fee is. So we're going to actually do a transactional fund. We're going to do a double close and then have the end user cash fix and flipper come in and buy it behind the transactional fund. So we just sent a deal over to Sarah. As a matter of fact, I just sent it 2 hours ago. We also will talk a little bit about bridge financing. Don't worry about it if you don't know what that is. Cross collateralization and commercial. So these are all the different asset types that we do funding for, and that I'm going to kind of briefly cover today. Bob Hope once said, "A bank is a place that will lend you the money if you can prove that you do not need it." That is so true, right? We've been in this space for a very long time. We struggled to find our first money tranches. Our first fix and flip, we used a bank called Burke and Herbert. And so that was about 22, 23 years ago. But we weren't very bankable at the time. But now the fact that we have quite a few assets, banks actually approach us for us to get money from them. And so it's kind of funny how things have turned 180 degrees, but this is a good quote from Bob Hope to keep you guys entertained. Now, let's talk about the money sources. And one of the things I'm going to try and do is I will try hard to keep this at 45 minutes. Very doubtful. I'm a blabberwalkie. And so what I want you guys to do is after I cover each different money source, I want you guys to go ahead and ask questions regarding that money source, and then we'll tie it up at the end. So what I'm going to cover is hard money lending. If you guys don't know what that is, it's basically asset-based loans. I don't qualify the borrower, I qualify the asset. That's sort of what we do in one of my main business lines. I'm also going to talk about what's called subject to the existing mortgage, sub-2 financing. Sarah, I don't know as a company if you guys do sub-2s.
We do.
You do, and
we have a lot of documentation for them, so people
that's
are
okay.
wide eye and bushy tail, but we do.
Yeah, that's good to know because we're going to go ahead and cover that in a matter of fact, of all the four money sources, I'm going to cover that one in depth. And so we'll cover that from a disclosure standpoint too, because it's very important that when you're working with a sub-2 title company like Titan Title, there's a lot of disclosures that have to come into play. And as a buyer and or a seller, you have to understand the disclosures. You've got to know what you're getting yourself into. And then I'm going to cover debt service coverage ratio loans. That's basically a strategy where you're going to use a hard money lender to do a buy and hold. You're going to use the hard money lender to fund most of the purchase, fund all the renovation. You're going to get a tenant in there, get the property performing from a buy and hold standpoint. It could be commercial as well. And then we're going to show you how to utilize DSCR financing to go ahead and refinance out. And then we're going to briefly talk about owner health financing. And the reason why I'm doing that is because I'll cover a deal where I own a trailer park where we got owner held financing on that particular deal. Now I know it's commercial based, but I do want to talk about owner held financing because owner held financing doesn't have to be in first position. It could be in a second trust position or a third trust position if it makes sense, because especially if you're going to buy their property subject to, you could use an owner held financing to be in second trust position. So we're going to cover that. All right, let's go. Hard money lending. You're going to hear the term hard money lending. It's synonymous with private lending. It's synonymous with this new thing called RTL, real estate transitional lending. You're going to hear it synonymous with bridge lending. I mean, there's a lot of terminology that goes behind the word hard money lending, because what the hard money lending space is trying to do is they're trying to get rid of the moniker hard money lending. I don't care. I still like hard money lending because what it is it's basically lending on the hard asset. So for example, if I have a fix and flip, the house is worth 500,000, investor buys it for 300,000, it needs $50,000 in renovation, it's in Northern Virginia, odds are I'm going to lend the entire $350,000 against that asset. That's what it's about. I qualified the asset. Um, some of the things that you got to understand, there's some terminology that you have to understand. I didn't put both of them in here, but I'll cover it right now. The after repair value, we lend into the after repair value. I do not care what you're buying it for. I do not care what the renovation is at this point. So I will lend it. I'll start with the after repair value and I'll lend multiples and I'll show you an example of a deal here in a second. The other thing that's not in here is this thing called loan to cost. You have to understand the terminology loan to cost, and that's basically the purchase price plus the renovation, and then we lend on a multiple of that, and I'll cover that in a spreadsheet here in a second. In our case, everything's short term, 6 to 9 months for the most part. And then if it's something in Washington, D.C. or something that needs a full gut reno, I'll go out a year. It shouldn't take you more than a year to get that reno done and get that house sold or even rent it out. It's short term. In our case, we don't have any applications. However, if you are a borrower and you are going to do a DSCR loan to refinance us out, then I am concerned about your credit score, but I still don't really have you fill an application. I say few, if any, income restrictions. We don't have any income restrictions. I don't have any tax returns. I can lend out to what's called I-10 borrowers. So as long as you have a government tax ID on an LLC, we'll go ahead and lend out to you. Hard money loan types, we have a bunch. Fix and flips, we have fix, flip, and renovates. I have buy and hold loans. I have bridge gap funding. I have transactional funding, which is basically for the wholesalers if they want to do a double close and not disclose their contract assignment fee. And we do multi-collateral loans, and we also do LLC purchasing. You're probably asking yourself, what is LLC purchasing? And I need to cover this really quick. And the reason why you use a hard money lender to do LLC purchasing is because if you guys are familiar with the short sale world, and you're buying a short sale, this is a strategy where you can wholesale your short sales. Okay. And the way you do it is that you buy a short sale in the name of a single use entity LLC. The single use entity LLC gets pre-approved by the bank from the short sale to buy it. Now, if you're getting it at a pretty good price and you just want to sell the LLC, then we'll go ahead and fund the sale of that LLC. So that's another thing that we're doing too. And as the markets change, like they're changing here up here in Northern Virginia, you're going to start to see more short sales. As a matter of fact, we just recently bought a short sale up in Baltimore by Marymount University, and it was a very good short sale. It was reverse mortgage, and so some elderly folks owned it, and they were encumbered about $700,000, and we picked up the short sale in a single use entity LLC for about $265. And so we use that as well as not only lending against it, but we'll also buy with single use entity LLCs and then go ahead and flip out of it. All right, let's see, I might have skipped something here. I'm going a little too fast on this. Okay, scenarios for hard money, right? What I'm going to cover a little bit later is that hard money rates are high. We go out at about average 12% 3 points. Sometimes I'll go as low as 11. Sometimes I'll go as high as low as 2.5 points. And so the rates on hard money are a little bit higher. So you got to understand that. But why do people use hard money? Obviously, you need cash, right? A lot of folks that need us aren't really bankable. And so you use us because we give you the highest leverage into the deal itself. You need immediate need for financing, as Sarah will tell you. Most of our hard money loans, I need to close in a week or less, mostly 10 days or less. And so we close right away. And a lot of other lenders or companies can't really do that. But that's sort of my norm for my business is because you need to close quick. You might be buying a pre-foreclosure where the auction date might be, 10 days from now and I've got to close in 8. I mean, that's kind of the norm for us. We do it all the time. And that's why you guys need to get a nice investor-friendly title company like Titan Title, because the name of the game is the quickness to the title abstract. It's getting that title approved, it's getting the title binder, and it's getting that thing closed. And so that's really important. Bad credit, I don't check credit. However, I am interested in credit. If you are going to refinance me out with a DSCR loan, and it is a buy and hold, that's your strategy, then we're going to need to see a 660 or better on the credit score. So I do care, all dependent upon my exit strategy. Further leveraging of your business. A lot of times you got investors out there that might buy stuff all cash. But then that third deal might come around and it's a great deal, but you just ran out of cash because you're investing in two other properties all cash. You use us for the revenue of your business. And also too, more importantly, OPM, right? Other people's money, right? And so when it comes down to an ROI of using your cash in your pocket, using a hard money lender is going to really put your rate of return on steroids. So that's why people pretty much use us too. Now, hard money versus other lending types. Typically, and I do say typically, we do not invest in primary residences. Okay. I have done some stuff in the primary world, but not too much. We have an attorney originate the paperwork, and then they assign us the loan. And so we don't do that very often. Let's say out of, let's say, 100 loans, I might do one or two, if that. And so we do not. Usually we're a business-to-business lender, LLC to LLC. We do not sell loans. I have never sold a loan. We've been in business for about 13 years. I do about 12 to 16 loans a month. So I'm doing maybe 140 to 150 loans. And so we have never sold off one loan. We manage everything. We service everything. If you're the borrower, you borrow the money from beginning to end. Our loans are short term. It's really not 18 months. I go 6 to 9 months if I can. If you got a full gut renovation, I'll go out a year. I've got customized lending criteria. I change it all the time. I'll go through an example here in a second. I can close in 24 hours. Now the caveat behind that is I'm usually replacing out another lender that can't lend on the day of closing, and the title binder is there. You just simply replace us with a title binder. I send you out a term sheet, and then we can fund within 24 hours. I've done a bunch of those deals, but I don't like to do it. Title companies don't like to do it, but we have done it. And it's basically an asset-based loan. No credit, no income. And so what do borrowers need to know? Remember, when you're borrowing from us on a hard money side, it's a handshake, right? And so borrowers need to know the after repair value of the property. I'm going to help you with that, or your investor-friendly agent is going to help you with that. You got to know the project budget. You have to have a great contractor. I was just on the phone call just a minute ago but I don't know if Jessica LaRue's on this phone call, but I told her, I said, I don't mind working with first-time investors. As a matter of fact, I love it. And so what I do on the hard money side, though, is I qualify the contractor more so than I qualify the borrower. So don't take offense to that statement, because the number one persons that keeps me out of trouble are the contractors, because what you have to understand is that I've already vetted the deal from the asset standpoint. I've vetted the renovation budget, I've vetted the ARV, I've vetted you, the borrower who's buying it at a good deal. And that's why we don't mind dealing with first-time borrowers, is because the way we look at it is if you found the good deal, I don't care if you're a first-timer or a 20-timer, I'm going to give you the loan, because congratulations, you just found a great deal. Let's go make some money. And also, too, the other thing that we need to do collectively, me and the borrower, is that we need to ensure there's a profit margin. I can't tell you how many deals I turn down every day just because I'm like, how are you going to make money? That's always my question, right? How are you going to make money? Because I'm going to make money. I need to make sure that you're going to make more money than I'm going to make, because I don't want to do a bad deal with you, because I want you to come back 1 time, 10 times, 5 times, 20 times, right? I don't want you to leave the reservation. So if I don't like the deal and I don't think you're going to make money, I'm going to tell you that right off the bat, because I want to avoid problems with the deal right off the bat. So keep that in mind. All right. What do borrowers need to have? It's very simple with us. You need to have an LLC in good standing. First and foremost, I don't care where you're at. We're going to go check and see if you have an LLC in good standing. You got to have a hazard liability insurance or builder grade policy to protect us and protect you on the insurance side. And also, too, more importantly, you need a lender's title policy. No ifs, ands, or buts. We require a lender's title insurance. And I have had to make a title claim or two in the past. We've had situations where the title company, especially in Washington, D.C., they look at the online land records, right, which is a good system, but they've missed a couple of tax liens, IRS tax liens. And so we have had to go back and file a title insurance claim because the IRS tax lien was ahead of us. And so we've had that happen before. And so, we require a lender's title policy. No negotiation on that. All right, underwriting criteria. You call me up, you want a loan. The first thing I'm going to ask you is, what is your exit strategy, right? How am I getting paid back? Not how am I getting paid back every month, but how am I getting that whole loan paid back? And so the different exit strategies, it's obvious, right? Fix and flip. You're going to put it on the market. You're going to pay me back. If you're going to keep it in your buy and hold portfolio, at that point in time, I need to know because I need to know that you're going to refinance me out with another lender, whether it's a DSCR product, whether it's a 30-year normal mortgage as an investor loan, whatever it is, I need to know because at that point in time, then I'm going to ask you what your credit score is. And it's not even a soft credit pull. I'm going to ask you, and you're going to tell me because if we get 7, 8, 9 months down the road and that credit score that you told me was a 680 and it really isn't a 680, it's 620, we're going to have problems because you broke the trust bond and I doubt I'll ever lend to you again. So, because what I'm trying to do is I'm trying to build a relationship with you, and it's got to be an honest relationship. And so, if the trust is broken, that's okay. You go use another hard money lender because I don't really want to do that loan. But even though I've already done it, I doubt I'll do another loan again. Um, we determine the ARV, and this is sort of where we kind of exchange information. You're going to determine your own after repair value. And then I'm going to check you a little bit. I'm going to run comps myself because I am the appraiser, the broker price opinion, the underwriter. And then we're going to lend up to 75% of the after repair value. Now, remember, my lending criteria changes all the time because we're in a market that's a little turbulent. And depending upon where you are, and depending upon the comps, and depending upon the subdivision that you're buying into, I'm going to change my lending criteria on the fly. So, for example, if you're in Northern Virginia and it's still a hot market, hot subdevelopment market, there's no inventory, I'll go to 75% after repair value. Nobody else does that in this industry. They all want to lend at 65%. Now, if you're on the PG County side, I'll probably go to 70%, maybe 72.5%. I vary those percentages, all depend upon who the borrower is and where I am. If you're in Washington, D.C., and it's a full gut renovation, it needs a $150,000 renovation, guys, I might go to 60 to 65% ARV. I'm very conservative because those full gut renovations are a problem. You go through your budgets like crazy, and so it's more risk to the lender. And so I'm going to be very conservative on the loan to value of the after repair value. The next bit of terminology that you need to know is this thing called LTC, loan to cost. Basically, what it is, it's the purchase price plus the renovation, and we'll lend 85% to 100% loan to cost. So if I really, really like the deal I sort of talked about earlier, where the ARV is $500,000, you're buying it for 300, the renovation's 50,000, and it's in a Northern Virginia subdivision that's flying, I'll lend you 100% LTC. Nobody else does that. All my other competitors want to lend 185%, 90% LTC. We'll go 100 if I like the deal. Loans have nothing to do with the purchase price. People always call me and ask me, well, what LTV am I going to lend on? That's loan to value. I always say the same thing. I'm like, no, I don't loan into the loan to value. I loan into the LTV of the ARV. I start with the ARV first because I'm not worried about the asset. Because we have fixed and flipped so many houses, if I have to take that loan back, I'll just go ahead and execute it on myself and sell it myself. But I don't want to do that. That's not why we're in the hard money business. Length of the loan, right? If it's a full gut reno in Washington, D.C. and Petworth, $150,000, $200,000, I'm going to give you a year loan. Yeah, right. I only want to give you a 6-month loan, but I know better. It's going to take you a while to do that renovation. So length of the loan. All right. Here's the way we underwrite these deals. I know I'm 25 minutes in, but hopefully I'll cover this fairly quick and get to the end of this hard money section. So what I do is, if you look at the spreadsheet, it's a 1, 2, 3, 4 process. Number one, you're going to tell me the purchase price. You're going to give me the renovation budget. Okay. Then what I'm going to do is we're both going to agree on what the after repair value is. In this case, 209 Oglethorpe Street. That's a property in Washington, D.C. It's next to Petworth. It's in a development called Brightwood. And this was an actual live deal that we've done in the past. Number two, what am I going to do? I'm going to take your ARV, my ARV. We're going to plug in some numbers. Well, what percentage am I going to lend on the loan to value of the after repair value? Well, in this case, I'll lend out 70%. Okay, so I've got 400,000, 402, 500. What loan to cost do I feel comfortable with this borrower? Well, I kind of want this guy to put in about 5% skin in the game, 399. So then what I do is I go into number 3 on the spreadsheet and I put a proposed loan of $400,000. So I'm going to loan $400,000 into this deal. He's buying for 360. Reno is $60,000. So I'm almost loaning 100%. So the only thing that he has to come up with is $20,000 into the deal plus closing. Okay. The deal spread in this particular one was about $155,000. So there's a lot of room for profit for this borrower. And so that's how we build a loan. And so number four is basically your cash out of your pocket. Down payment, 20 grand, closing costs, approximately 20 grand. So you're going to have $40,000 in a deal where your potential deal spread is $155,000. Now, remember, the deal spread isn't the profit because what's coming out of the deal spread of the 155,000 is going to be your closing cost to buy it. It's going to be your holding costs, right? Because if you go 6 months, you're going to have holding costs with me. And then the last bit that goes into that deal spread is you're going to have to pay to sell it. So you might have to pay an agent. If you're not an agent, you're going to have to pay an agent to list at 2.5%, usually 3% maybe. And then you might have to pay buying commission. You might have to pay some closing costs. So you're going to have to pay to sell it. And so one of the things I look at on the deal spread is there enough room in that deal spread for this, number one, to be a safe loan, but number two, you as the borrower to make money. And so that's basically how we build the loans. Now I'm getting towards the end of this section. What are the advantages of hard money? You can close in 24 hours. You can close in a week or less. Leverage, right? I just talked about that. We can lend 95 to 100% of some of these deals if I like them from a loan to cost standpoint. You get approved on the phone with your hard money lender. Right? I'll approve you right then and there. I'll qualify the deal with you on the phone, and I'll tell you exactly what I'm going to lend into it. And then what you need to think about as a borrower is that for us, what you're doing is you're basically renting our money to make money, right? We're here to help you make money. And so basically, that's the way you got to look at it. We're a team. We do get paid a little bit more because this is the business that we're in. It is a niche business that we're in. And for us, there's no prepayment penalty. So if I give you a 9-month loan and you fix and flip that thing in 3 months, bravo to you. You're going to get to keep most of the money. I don't have any prepayment penalties. So that's a very important question that you need to ask other hard money lenders because most of them do require a 3 to 6 month prepayment penalty. So you have to ask that question. Okay, what are the disadvantages? Shocker when I say rate and points. I hope you guys understand that. It's not going to be your run-of-the-mill 7% interest rate in a point. It's going to be a little bit higher, but there's reasons why you're paying that. Shorter terms, right? My average loan goes out about 4 to 6 months. I mean, it's a 6-month loan, but I get paid back within 4 to 6 on most of our loans. And so shorter terms. And then the other thing too that you got to ask yourself is if I give you a 9-month loan and you price your asset way, way too high because the market's changed or because you think there's gold buried in that house, and you blow through my 9-month loan, we're going to have extension fees. So you have to understand your extension fees when you do the loan because one of the most important things that you have to do is you got to be able to perform. So if you're a fix and flipper, you got to get that property renovated, get it on the market, and get it sold. Now, if you're buy and hold investor, same kind of thing. You've got to get the property renovated, get a tenant in there, and get me out with a DSCR lender. Okay, so you want to avoid the extension fees with us. So as long as you understand that there's extension fees with this loan, then we're okay. But there are going to be extension fees if you blow through our term of our loan. All right. Any questions, Sarah, on the hard money piece?
No questions on the chat, so I say let's get to subject to financing.
Okay, let's go. Subject to, what is it? All right. Subject to financing, and I don't want you guys to get this mixed up with loan assumptions. This is not loan assumptions. We're not a VA loan. We're not talking about FHA loans, USDA loans, VHDAs. Even though I do have a VHDA example in here and I have an FHA example in here, we're not talking about loan assumptions. We're talking about subject to. What is it? Subject to is where you purchase a property subject to the existing loan. The deed goes in your name, the buyer. However, any debt instruments that you're doing a subject to stays in the name of the seller. That's very important to understand that. The seller is still going to have a loan in their name. Okay? There's no formal bank approval process, which means when you buy a house subject to, the closing costs are going to be much cheaper. Okay? Look at it as if the purchaser/investor just simply takes over the payments. Right? However, here's the downside, and this is where you got to understand the downside. Most mortgages have a due on sale clause. As a matter of fact, Sarah, I don't know, this might be all, but I did caveat it with most.
All
But
of them.
all of them. So I need to change most to all. Why do you care? Well, because the lender has the right. This is the key. This is key terminology here. The lender has the right, but not the obligation to call the note. Okay? Now, ask me the question, and I'll ask myself the question. Well, how many loans have I seen in my career that have subject to where the loan has been called? And the answer is 2 out of about 100. And let me go over the scenario on why those loans were called and why the loans haven't been called. The first scenario I want to cover is the 98% of why they're not called. And the reason is because if it's a Fannie Mae backed loan, Freddie Mac, government sponsored loans, or it's a portfolio loan with, let's say, a Wells Fargo, Capital One, Bank of America, the bigger institutions are not going to call these loans. Why? Because they would much rather have a performing loan. Even though the performing loan is at a lower interest rate, they would rather have a performing loan than to call that loan, get the money back, and then redo a brand new loan. They would rather, they're in the performing loan business, right? And they would rather have that. That's why the bigger institutional players don't call these instruments. Now, where is a scenario of where I know of one or two cases where a loan has been called? Okay, and that's with the community bank world. So if a bank is a community bank means the bank has about, in my case, it's about $2 billion of assets or less. In the Northern Virginia area, it's like your Burke and Herberts, your Freedom Bank of Virginia's, Fauquier Bank, Oakview Bank, all these smaller banks that have assets less than 2 billion, those are community banks. What happened was in the Sandy Spring Bank, who, oh, by the way, got bought out by Atlantic Union this past weekend, is that Sandy Spring was underneath the FDIC sites. FDIC was threatened to come take over that bank because they held on to a lot of bad debt instruments in the commercial office space. And so they were in the FDIC crosshairs. Now, what Sandy Spring had to do is they had to raise money. They had to raise income. How do you do it? Number one, you raise deposits. You increase the money market interest rate, you get deposits. Number two, how do you do it? You raise investor money, right? They might offer stock or something like that. And they might try and get investors to come in and buy stock, put it in their coffers. Number three, how else do they do it? They sell off assets. Okay? They might have some non-performing notes. They might have some commercial assets. They might have some REOs. Okay, let's get those off the books. Let's bring in cash. And the next way that they will do it is they'll say, okay, let me see which of our loans in our loan portfolios where the title has changed, the insurance has changed, and it might be a sub 2. And let me go ahead and call that sub 2, make that new owner pay me back. So Sandy Spring, in a couple of cases, utilized that strategy to call the note and to raise capital to help thwart off the FDIC. So that's the only time that I've known about a sub 2 getting called. And so just as long as you guys understand that, that's very, very important that you understand that. Now, why do you do sub 2, right? Obviously, it reduces the cost to buy a home. If you're a borrower, right, and you can't get credit, you can't get approved for a loan, and you're non-bankable, this is a great way to buy a house, right? Why do most investors do it though? They do it because they want to capture the lower interest rate in a higher interest rate environment, right? Because on a buy and hold, there's more room for profit cash flow, right? The other thing why you want to do it is that you're further into the amortization schedule of a sub 2, because remember, most of these guys are 30-year mortgages, and you might be 3 years, 5 years, 7, 8 years into the AM schedule. And then also too, like I said, it's a method of purchase of property in case you don't qualify. All right, let's just go quick. I'm gonna have to move really quick on this
Hold on,
because I
Charlie.
want.
We have two questions.
All right, let's go.
One is from Tim. I gave him an answer, but I want to hear yours. Is there a way to contact the lender in advance to have them legally promise not to call the loan, or does one simply always have to accept the minimal risk that they'll call it?
Yeah, I would accept the minimal risk. I would not call them. As a matter of fact, it's going to be very hard to call them because the way title looks, and Sarah can testify to this, is that when you do a title search, a lot of times what's going to pop up is the loan servicer, right? And so the loan servicer is servicing a loan for an investor. Odds are you're not going to get to the investor. Man, you can call all these different investors till you're blue in the face, but these banks are not picking up the phone. And as a matter of fact, a lot of these mortgages are what's called they're in tranches. And so it's very hard to find the underlying investor of these loans. So I would just do it and do the minimal risk.
And then Alexandra is
Well,
asking,
hold on, Sarah. Is that your answer or what was your answer?
I just said they won't do that unless you want to do an assumption.
That's right. Yeah.
And so it's just one of the risk.
Yeah, and some of the conventional loans won't do assumptions. It's basically the government sponsored loans that are doing the assumptions. But yeah,
Yeah.
that's great. Okay.
So same answer. So Alexandra is asking, what would make this appealing for a seller? It seems like all the risk is on them.
Oh, no, that's a no, 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 no. Oh, that's a great question. And so let me go ahead and segue into why realtors need to know the strategy to help sell their listings. Um, it's very important as a listing agent that you understand the underlying financial instrument of the property that you're listing, right? Because what's going on now is that you guys have stagnant listings. I don't care where you're at, you have stagnant listings, some of you guys. And so by understanding the underlying mortgage, right, whether it's VA, FHA, USDA, VHDA, whatever the first time home buyers, those are able to be assumed. And especially if they have lower interest rates, they could be assumed. Okay, that's a very big critical sales point when you're trying to sell these listings. Now let's talk about how it impacts the sub two world. Understand the underlying mortgage, understand the interest rate. This is a very good way to sell your listing using the sub two. However, what you're going to have to do with the buyer is make sure that they have a good cash component buying into your listing so that they're going to do the sub two, that there's less risk for the seller that that sub two is ever going to get foreclosed on. So you've got to make sure that there's a good cash component on that subject two to utilize to sell your listing. Yeah, so that's a good question. I hope I answered it. All right, let's talk about the first deal example. All this stuff is on public record, guys. I go over deals so that you guys can understand how we've utilized subject to in our purchasing world and my lending world. And so let's talk about this one. It's a very simple fix and flip. 16312 Taconic Circle. It's a Clear Sky Properties purchase. We've already fixed and flipped out of this house. 2-bedroom, 1-bath condo. The owner purchased it for 2000 in 2008. It was a VA loan. 185,940 was the original amount. The interest rate was 3 7/8. Principal and interest payment was 872. Annual taxes 2,800. Condo fee was 265. It was vacant for at least a year. I'm sorry, I've got a typo in this chart. I just noticed it. It was vacant for at least a year. Referral from a real estate agent. That's how we got the deal. But when we bought it, the current balance on the VA loan was paid down to 185 to 168. This was a distressed asset, but it wasn't a distressed asset because it was financially distressed. It was a distressed asset because the guy hadn't lived there for a year because he got a girlfriend up in Maryland. And so he basically ignored the property for a year. All right, remember the current balance at 168 because we're buying it at 200. So we bought it for 200. We subject to the existing loan for 168. Cash to seller was about 32,000, but there was some closing fees included in there on his sell side. So he got about, I don't know, $27,000 at closing. Our renovation costs were about $15,000. We bought it September 22, 2023, and we sold it about, was it October, November, about 90 days later. We made 3 payments to his sub two. Now, one of the things we could have done is I could have kept this as a buy and hold and socked it away in our rental portfolio, and I would still have it performing sub two to this day. One of the things that we told this guy is he was a VA, he was a veteran, he was a military guy. One of the things he wanted us to do was to fix and flip it. He wanted us to eventually pay off his VA loan so that he got back his VA entitlement of $170,000. So I promised him that, and that's what we did. So we made about $38,000 in about 3 months, and we purchased a sub two, paid it off, and he's made whole. Loan's paid off, not in his name anymore. Okay, here's another example of a sub two. As a matter of fact, one of my students has this property to this day. She still owns it. And when did she buy this thing? 2021. So she's had this for a rental for almost 4 years, 5 years. Here's the background. Cookie cutter house in Culpeper, Virginia, 3 bedrooms, 2 baths, 1998, 1-level house. House was in pre-foreclosure. House was vacant, and it was an out-of-town owner in New Jersey. Interest rate, 3.75%, 30-year AM schedule. It's a VHDA loan, and for you guys that are outside of Virginia, VHDA is the first time Virginia home buyer program. It's very similar to FHA, but it's the Virginia's version of FHA called VHDA. All right. Loan origination date 2015 for $218,000. By the time that we got to the guy that was in foreclosure, the loan amount was about $192,500. What you have to understand is that the approximate loan amount was 192.5 after we paid the arrearages, right? And so I'm going to cover that. The arrearages were about $44,000. So here's what we did. Sarah, you might want to close your ears on this deal, because here's what we did. I met the guy with the student up in New Jersey because that's where he was living. I knew what the arrearage amount was, 44,002, and we went to a Wells Fargo. So what I did is I put a second trust on the property for my student. I paid him $10,000. I brought the loan current 44,002. So what I did is I got a cashier check from Wells Fargo for 10,000 bucks. I had Wells Fargo send the substitute trustee $44,000 to stop the auction. Substitute trustee received the money. Owner received his $10,000. I also, with me, had a deed in my hand that I had drawn up by an attorney. I had him sign and notarize the deed. Okay. We bought the house for about $246,502. I wasn't the we. I was a lender of about $54,002 second trust hard money. She got the house subject to the 192.5, and that's what the transaction looked like. 246,502. All right. Then what I did is I had the student go ahead and record that deed in the Culpeper County Courthouse. She now owns the house, sub to the VHDA. The after repair value on the house is $375. The loan payment is $1,365, principal, interest, taxes, and insurance. The rent payment was $1,950. She bought a house, $250. Well, she had to put a little bit of renovation into it, but the positive cash flow was $585, and she had approximately $100,000 equity position. You guys would do that deal all day, right? Now, one of the things that we had to do, though, is with the owner, we had to do a handshake, and we had to say, hey, I actually forgot his last name. We said, how do we make the VHDA payments? So what he did is he gave us our user ID and login to his VHDA website, and she's paying those payments now. There was a small second trust on the top of the VHDA. All right. But it's $585 positive cash flow. I'm not exactly sure what the rent payment is today. It might be $2,200, $2,250. I'm not sure. But this is a way that one of our students bought a buy and hold, and she has it to this day, utilizing hard money as a second trust. Oh, by the way, I got my $54,000 back, paid off. So now she just owns the house with that first trust subject to. Now here's another deal subject to. In this particular case, this is a fix and flip where the guy fixed and flipped a property and he used that as a second trust on the sub two. So and so that's that, and these are the numbers associated with that. I can go through them, but I think I'm running quick on time. Let me just do a time check. Yeah, I better just quickly run through this. The last sub two deal I want to cover is and this is why you guys are here. I'm trying to bring this thing round circle on how you can utilize little or none of your money to make money on these different financing strategies. This is a sub two deal that we recently did this month. No, September we did it. And here's the background. It's another house in Culpeper, single family house, 4-bedroom, 2.5 bath, 2-car garage, 2018 built. Like, we like these newer houses. Original loan is an FHA loan, $250,498. Arrearages was $37,733. This was another pre-foreclosure buy, right? They're getting auction. We have to close this thing before the auction. But the interest rate, 2.875%. Guys, what a great interest rate. Okay, the current loan amount was $229, and there was a second trust on it for $27,000. Here's what we did. Student bought the house for $310 with no money out of her pocket, none. $229.31. That's the purchase price. That was the balance on the sub trust. I'm sorry, that was the balance of the first trust, the subject to trust. $37,733 was the amount to bring it current. We get $27,000 was the amount to pay off the second trust. The owner got $11,000. There was like $5,236 in costs for the owner to sell the house. So the total purchase price was $310. We gave this person the second trust, hard money second trust, for $90,000. So they own this house outright, but they own it with no money out of their pocket. Here's what they did. Here's what happened. ARV was $450. She simply wholesaled it to another buy and hold investor. She made for $365,000. She kept the sub two in place to the new buyer, right? One of my partners, as a matter of fact. My partner is making 1459 positive cash flow. However, the investor or the student made $55,000 without any money out of her pocket. Not bad, right? Okay, let's cover it real quick. Advantages to sub two deals. Interest rates, right? Terms of the existing notes. That's why you're doing a sub two. No application documentation, no credit check, minimal down payment of any. Like there's going to be some down payment sometimes, but if you're creative with your financing strategies, that's how you do it. You can buy it with no cash. Further into the AM schedule, right? Because in this case, I think it was a 2000 and heck, when was that loan? 2020. So this particular one's 5 years into the AM schedule. The one that was in 2018 is now 7 years into the AM schedule. Disadvantages, right? The Well, it's not really a disadvantage for you, but the biggest disadvantage for you is the bank can recall the loan on a due on sale clause. Biggest disadvantage. However, the disadvantage to the seller, well, it could also be an advantage. The former owner is still on the hook for the obligation. Now, remember, if you're a former owner and you're going through a foreclosure crisis, right, it's dinging up your credit. But this could also be an advantage because as the sub two buyer takes over that loan, brings it current, number one, makes current payments, guess whose credit's getting reported? The owner who's on the hook or the owner that used to own the house. So they're going to get their credit score increased. So there's an advantage and a disadvantage to being the owner. All right. Any questions on this? Sarah, any questions in there? Another little chart for you guys. This is worth its
Okay,
weight
we
in gold.
do.
All right.
So I think Jessica, if it's better for rentals or can use for fix and flip, that was responded to. And then Tim is asking if for some reason the bank called a loan, what do we as the investor have to do? Get the thing sold ASAP or find another loan?
Yes.
Yeah,
Yes. Yes to both. Plan B.
yes to both.
Yeah. Or raise, or hopefully you're buying into an equity position and it's a pretty good size equity position, kind of like the examples I said. There's no reason why you can't raise money as well, right? Because if you have a house that's worth 400,000, the sub two's worth $200,000 and you've been performing on this house, there's no reason why someone's not going to give you $200,000 against that $400,000 house. You could certainly use a hard money loan as a buffer while you're getting into more of a permanent financing. And so one of the permanent financing things you're going to want to probably do is just do a DSCR loan. I'm about ready to cover that. So that's actually a good segue into the DSCR piece. Good
And Charlie,
question.
just real quick, if you were having to get a new loan, if you were qualified with a regular bank, it'd be considered a refinance. So some of
Yeah,
the
right,
costs
right,
are lower.
right. The only disadvantage is obviously in this current lending environment, the interest rates are going to be a little bit higher. But that's okay. But that's plan B in case it gets called, right? You always got to have a plan B. If it's with a community bank and the community bank is in the FDIC's hairs, right? It might get called. And this is a good chart for you guys too, because one of the things, and the funny thing about it is I need to send this to Pace Morby and teach him. Um, but these are good ways on how to find subject to deals. And so this is a chart that's worth its weight in gold. I'll cover it really quick. Subject to mailers, right? When was the lowest historic interest rates that we've had? Between March 2009 and March 2022. I would target those guys if with some mailers. Added town owners, subject twos. This is a great way to do it. Driving for dollars, vacants and blighteds. Hopefully, if it's within that lower interest rate range, right? You're trying to find distressed assets and you're trying to find distressed owners. That's the name of the game with the sub two space, and more likely for you to get a sub two deal. All right. Really quick, and I'll go through the next topics really quick because I know we're running up against the hour. Debt service coverage ratio loans, what are they? They're loans for buy and hold investors, right? So you want to buy that investment property, you want to keep it. And I'm going to cover a strategy on how you do it with a little under money on your pocket. Income of the property is the key qualifier. I did not say your income is the qualifier. I said the income of the property. Can be done on a single property or a portfolio of properties. I happen to own a 36, 38 property portfolio. That's part of our rental portfolio where Sandy Spring, now Atlantic Union, has a DSCR coverage loan, and we're the borrower across all those properties. So we're utilizing DSCR ourselves, but just for bigger property, a lot more properties. Can be done on a single property or a portfolio of properties. I have a portfolio loan with those guys. LLC loans, primarily LLC to LLC, right? Business to business loans. They're going to require you to do 25% down payment if you're originating a DSCR loan on a buy and hold. If you're originating, they're going to require that. And I'm going to tell you a strategy here in a second on how to avoid this. 3 to 6 months interest reserves. Currently, right now, you need a 660 or higher credit score. Now, the question's probably going to be, well, they're lending to an LLC. Well, they're going to want credit scores of 25% shareholders or more. So if it's a 25, 25, 25, 25 of the LLC, they're going to want 4 credit scores. If it's a 50-50 LLC, 2 credit scores. If it's a 100% sole LLC, sole proprietorship, and it's a sole member, they're only going to want 1 credit score. But you're going to have a 660 or better. All right, now, how do the banks qualify this? They have this thing called a DSCR ratio. DSCR stands for debt service coverage ratio. And basically what they do is they take the property rents and they divide it against the debt of the property. That includes the principal payment, the interest payment, the taxes and insurance, and also association dues. Association dues are either HOA dues or condo dues. That's the bottom denominator. Income top, bottom is the expenses. So for example, if I have a property where I'm getting $2,500 rents and the payment and everything associated with it's $2,000, then my DSCR factor is 1.25. One of the things that you're going to hear lenders is they're going to say, oh, I want a 10% coverage. So I want a 1.1 debt service coverage ratio. I want 110% income, 100% expense. So I want 10% more income over expense. Yeah, in this case, this is a 25er, 1.25. You have 25% more income than the expense. And so that's a good ratio. And so the way you have to understand it is that the higher the DSCR, from a factor of 1.25, 1.5, the lower the interest rate is. So they're going to calculate the interest rate on a bunch of different factors. The value of the property, the amount of money you need to refinance it, the income of the property, your credit score, all these different things are going to factor into the interest rate. But the higher your DSCR rate is, the lower that interest rate is going to be. All right. Advantages of DSCRs: flexibility, multiple loans, multiple properties, no 10 loan limit like there is with conventional loans. Like I couldn't even get a conventional loan these days because I've got too many loans in my Social Security, so I couldn't even qualify. Flexible AM schedule. You could set it up 30, 25, 20 year, whatever AM schedule you want. Obviously, the higher the AM schedule, 30 years, the more profit you're going to make on a monthly standpoint, lower the higher the cash flow. Interest rates also too, remember, the disadvantage in this environment is interest rates. DSCR loans are running between 6.75 and 8.5. All depend upon the scenario. It used to run 4 to 5 back in the day, back in the good old days. So the interest rates are a little bit higher. Also, too, the credit score requirement. Now, the way that you want to use DSCR is what you want to do is you buy into equity, right? You use a hard money lender to go ahead and give you almost 100% of that hard money loan, including the renovation. You get a tenant in there. You keep the property. Remember, you're buying into equity, so you're going to have a good ARV. You hold that loan for 6 months and a day. You get a new stepped up appraisal, right? Because you're buying into equity. Then you go apply for your DSCR loan, because then the DSCR lender will take that new stepped up appraisal. He'll say, oh, this house is worth 400 grand. You bought it for 250 and put 50 into it, 300. Oh, okay, now it's worth 400. I'm gonna give you a $300,000 loan, a DSCR on your rental performing house. And so that's a good way to use a hard money lender in conjunction with a DSCR loan, right? In order to utilize less money out of your pocket to buy that cash performing rental. And so that's how you use a multiple of these guys and to do this. And that's a really, really good strategy. And we have hard money borrowers doing this all day. Now the problem is finding the good deal, right? It's how to find distressed assets. That's the issue. The issue really isn't on the financing side, because there's a lot of different ways to combine these strategies to go ahead and utilize little or no money out of your pocket. Now, the last thing I want to cover is really quick. I'll cover owner financing. And obviously what owner financing is, and what most people think is that owner financing is where I own my property outright, and I'm going to go ahead and, instead of selling it in capital gains, I'm going to do a first trust on that property, and I'm going to be the bank as the owner. Well, that's exactly what it is. And so, but what a lot of people don't realize is that, and I was talking to another agent today about a sub two on one of her clients, And I basically told her, I said, this might help your client sell the house. And there was a lot of equity in it. I said, why don't you just have somebody buy it as a sub two, have your owner create a second trust, right? And they become second trust position and they can create a debt instrument where they're receiving income. So the owner finance trust doesn't have to be a first trust. It could be a second trust or a third. Usually it's a first trust. But as long as you guys understand that a lot of owners right now, especially the elderly or especially elderly investors that own a lot of properties where they got to pay capital gains on, a lot of times that they'll agree to do a owner held trust because that's going to help them avoid the capital gains tax. It becomes what's called a land installment sale or a contract installment sale. So then they're just paying on the interest of the money that they're receiving off of the trust as far as taxes are concerned. They're not having to pay the entire capital gains tax. So this is a very good incentive for owners to own their own financing. Now, one of the deals that I did was I own a trailer park through a nonprofit charity. And the way I purchased that dilapidated trailer park was I had the owner hold a $1.3 million owner held trust where I was paying this owner $10,000 a month. So I was able to buy that trailer park, 100% financing, owner held trust at $1.3 million. And so that's how I've utilized the owner held space to also buy properties. Now, the next thing that we've done as well, okay, let's cover advantages of owner financing really quick. Interest rates, right? Because all the terms are negotiable. Every single term is negotiable. Interest rates, AM schedules, balloons, it's all negotiable. You have no application documentation usually. Minimal flexible down payment, negotiate it. Avoid capital gains, installment contracts, fast closing, cheaper closing. And then disadvantages though. Here are the disadvantages. You got to understand this. Hard to find. They're not simple. Short-term loans, right? It's a balloon. Negotiate it. Some will only do owner held financing for 5 years, some for 10 years. So you got to negotiate it. And so let me tell you about one last deal that we did. And I was involved in a fix and flip in the museum district in Richmond. And so the way the deal worked was the house was worth $1 million, fixed up. The borrower was getting it for 600,000. However, the owner had a $200,000 first trust. They had a $100,000 HELOC, and the property needed $200,000 of work. Here's how that looks. Here's how it looked. We did a sub two on the first trust at 200. We did a sub two on the HELOC at 100. I provided a third trust hard money loan at $300,000. 100,000 went to the owner, so they walked with 100. The $200,000 went to the renovation. Now the fix and flipper had asset worth about $1 million in the museum district. They fixed and flipped it. I don't remember what they got, 950, $1 million, didn't care. My 300,000 hard money loan was paid off. The second trust HELOC was paid off, and the first trust sub two was paid off as well. And the fix and flipper made about $250,000. And that's how you utilize all these different financing sources, guys, that are at your disposal as investors. So as investors, you got to do two things. You got to know how to find distressed assets, and you got to know how to fund them with little or less of your own money. And here's what we did. Money sources, hard money, subject to the existing mortgages, debt service coverage ratio loans, owner held financing. Use a combo of those sources to fund your investment deals, and we're ready to go. Questions?
I love it. So, yeah, that's what I was going to say. If you or Sarah could do me a favor, Charlie, and put your information on the chat or where they could sign up, I will tell you that they have monthly meetings where a bunch of investors will sit and
Yep.
they'll talk about their cases so that you can start learning or even talk about properties they found that they're trying to sell. So I've gone to a few. Andrea from my team has gone to a few.
There you go.
And they are fantastic. A lot of great information. In fact, to one of them, I brought my 12-year-old, and he was all like gun ho, wanting
Let's go. Let's
to
make some
learn how
money.
to invest.
Let's make money.
Um,
That's how you register. That's me right there. Uh, Follow me on all the social medias. We're trying to get better at it. We're not the best, but we're getting better at it. And the reason why we're not that good is because of me. I'm not really a social media guy. I have my camera crews follow me around, and we try to post some investor friendly content as much as we can. And that's how you get a hold of me. I'll stay on as long as the questions keep coming, Sarah. As long as you have me, I don't have a hard stop. So if you guys got more questions, feel free to ask.
So we try to have a hard stop to get people
Okay.
kind of like
All right.
there is one last one from Tim, hard money. Do you have a hypothetical spreadsheet for the holding cost? Deal spread is after you consider holding costs, etc., or is it before
I
those
do.
costs? Tim, I will tell you that he goes over this on the meetings, and I believe you also have classes and mentorship. We've had a
I
couple of
do.
agents who have gone to these classes and gotten all this information
There you go.
as
Yeah.
well. But Charlie, you want to address that one real quick?
Yeah, I would actually bring it up to share it, but we probably got to get going. I've got two spreadsheets with a buy and hold and a sub two in mind. I've got the cash flow spreadsheet, the monthly cash on cash return, and your annual cash on cash return. And then we also have another spreadsheet that if you're buying it into value, right, you're buying into an equity position, what your cash on cash return looks like buying into the equity position plus, let's say, 3 years of appreciation at, I think we go 5% a year, and what your cash on cash return looks like after 3 years, after 2 years, after 1 year. You can extend it out to 5 years. So we have a lot of these spreadsheets that are very variable that you can change, basic parameters behind it, especially on the buy and hold piece. And so we offer a lot of that stuff. I would share it, but I would have to go find it.
Well, you have Tim at Charlie's putting his information in there. So you can always email him. And again, we are here to provide value. So feel free to DM us or Instagram us or send us an email and let us know what other classes you are interested in us having or other masterminds. You can also find a recording of this class as well as every other mastermind we've done in our YouTube channel and in our monthly newsletters. So in our monthly newsletters, we not only give you a little bit of a blurb of what's going out there in the world, but we are also going out there and putting our masterminds. I will tell you right now in DC with TOPA, there's a lot that's going to be coming down the pipeline. And maybe there's a seller who doesn't, who's got a renter in there and he doesn't want to go through the TOPA thing. And they might be a great investment for you. So, Charlie, thank you so much. It's the Titan Title Metro YouTube channel, and you can look at it again through our Instagram. Charlie, you're amazing as always. Thank you so much. You're
Yeah.
one of our favorites, and I can't wait to have you on the next mastermind. Have a
Anytime. And
great rest of
thank
your
you
day,
guys.
guys.
Yep. Have a good time. Thank you guys.
Bye.
Bye.